So you want to buy a ship. At any given moment, more than 100,000 commercial vessels are moving. They are carrying the iron ore that becomes your car, the oil that becomes your gasoline, the wheat that becomes your bread, and the container that becomes the phone in your pocket. Over 80% of everything traded across borders on this planet travels by sea on a ship someone owns. This is not a fringe industry. It is the circulatory system of the global economy, and it does not stop. The ships themselves look like the safest possible investment. Steel hulls the length of 3 football fields. Engines built to run for 25 years without failure. Cargo contracts signed years in advance, backed by mining companies and oil majors who are not going anywhere. Every signal points to a bulletproof business. And yet the person who owns the ship is, more often than not, the person who profits least from the voyage. A single modern Cape-size bulk carrier, the workhorse, that hauls 180,000 tons of iron ore across the Pacific in one trip costs upward of $64 million to build, and can still lose money on a voyage even when it sails full, on schedule, with the cargo paid for months in advance. By the end of this video, you will understand where the real money in ship ownership actually comes from, what happens to a vessel on the day it stops being profitable to sail, and how long this entire business model has left to run. And you will understand why owning one of the largest, most essential machines in the global economy can still leave its owner making almost nothing. Buying the ship is the smallest decision you will make. Most owners do not pay cash for a $64 million haul. They finance 60 to 70% of it through a ship mortgage, at rates that in the current lending environment run around STAT, prevailing ship finance interest rate, serviced every month for the next 15 to 20 years. Whether the ship is earning or sitting idle at anchor, the debt does not care if the ship is working. Then comes the paperwork that turns a hull into a legal trading vessel. Flag registration, classification society survey, and safety management certification together run STAT, registration and classification cost, before the ship has left the shipyard. You are paying to be allowed to work. Insurance is next, and it is not optional. Hull and machinery cover protects the physical asset. Protection and indemnity cover, arranged through a mutual insurer known as a P&I club, protects against everything from cargo damage claims to oil spill liability to crew injury. For a vessel this size, the combined annual premium runs STAT, annual H&M and P&I premium. One serious uninsured claim ends the company. Crewing a ship this large takes 20 to 25 officers and ratings, sourced increasingly from the Philippines, India, and Eastern Europe at a combined daily cost of STAT, daily crew cost. The crew is paid whether the holds are full or empty. Add to that a retrofit almost no one outside the industry has heard of. Every large ship now carries a ballast water treatment system, mandated under an International Maritime Organization convention to stop invasive species from crossing oceans in a vessel's ballast tanks at an installation cost of STAT, ballast water treatment system cost per hull. The regulation exists to protect an ocean the ship has not sailed into yet. Then there is dry dock. Every 5 years, and at the halfway mark in between, the vessel is pulled out of the water for a full structural and mechanical survey, steel renewal, propeller shaft inspection, hull recoating at a cost that, for a Capesize, regularly reaches STAT, special survey and dry docking cost. You pay this bill whether the freight market is up or down. Add the canal tolls. A vessel this size pays every time it transits the Panama or Suez Canal, easily running into 6 figures per crossing. And the true price of playing this game starts to come into focus. Most owners do not run any of this themselves. They pay a third-party ship management company a monthly fee, in the range of STAT, monthly technical management fee, to handle crewing, maintenance scheduling, and regulatory compliance across the fleet. Layer on port agency fees, stevedoring charges at every load and discharge port, and lubricating oil consumption, that alone can run STAT, monthly lubricant cost, for a vessel this size. And the owner has assembled a full corporate overhead structure before a single bill of lading has been signed. And you have not carried a single ton of cargo yet. What you are actually selling when you own a ship is cargo carrying capacity, space, and days, not the iron ore or the oil itself. And the price of that capacity is not set by you. It is set daily on a public benchmark called the Baltic Dry Index by a panel of shipbrokers assessing what charterers around the world are willing to pay for a vessel's hire on routes you do not choose, for cargo you do not own. You own the truck. Someone else owns the road. In early July of 2026, the Capesize sub-index of the Baltic Dry Index sat above 4,000 points, translating to a time charter equivalent. The standardized daily rate an owner effectively earns once voyage costs are stripped out somewhere in the neighborhood of $30,000 a day. Subtract STAT, daily operating expense in crew, insurance, technical management, and lubricants. Subtract the daily debt service on that $64 million hull. What survives those two subtractions, on most days, is a rounding error next to what the cargo underneath the ship is actually worth. The owner absorbs the largest risk in the transaction and keeps the smallest share of the reward. Carry that daily shortfall forward. Multiply it by the roughly 300 days a year the ship is actually trading rather than idle or in dock. And the annual gap between what the vessel could theoretically earn at a healthy margin and what actually survives to the owner's account stretches into the millions on a single hull. Multiply that gap across the entire global Capesize fleet, and an entire multi-billion-dollar asset class spends long stretches of any freight cycle barely covering its own debt service, one ship at a time. The owner does not even control demand for the ship itself. Guinea's Simandou iron ore project alone, a $20 billion development ramping toward 120 million tons of annual output by 2027 or 2028, will single-handedly determine how many Capesize vessels the market needs for the rest of this decade. The owner of any individual hull has no seat at that table. Some owners try to soften this by joining a commercial pool, a group of ship owners who combine their vessels under one operator to negotiate collectively in roughly the way a franchise negotiates supply terms on behalf of many small operators. Others stay fully independent, fixing every voyage themselves in the open market. Both are still price takers against the same Baltic Index. Neither one controls the single number that decides whether the company eats this month. This is the fundamental problem with owning a ship. You are running one of the most heavily capitalized logistics operations on the planet to deliver a commodity service on which you make almost nothing. Keep two questions in mind as this video continues. What actually happens to a ship on the day it stops paying its way, and how long this entire model has left to run? Both answers are coming, and they arrive from the same direction. Here's the reveal that changes the whole picture. The money in ship ownership was never really made carrying cargo. It was made buying and selling the ship itself. Shipping runs in violent, repeating cycles. In 2016, the Baltic Dry Index fell to an all-time low of 290 points, a level so depressed that some owners were earning less per day than it cost to keep the ship's lights on. By late 2025, the same Capesize segment had rallied hard enough to push the Baltic Capesize Index above 5,000 points. And new building prices for large bulk carriers had climbed roughly 14% in a single year, even as smaller vessel classes softened. The gap between those two numbers is where the fortune sits. An owner who bought a Capesize hull during the 2016 trough at a price depressed by the very oversupply that was crushing freight rates, and sold it during the subsequent rally, could realize a capital gain worth several years of ordinary charter income collected in a single transaction, largely untouched by whatever the freight market happened to be doing on the day of sale. Secondhand vessels today trade at roughly 93% of new build prices, a gap so narrow it tells you the market is really bidding on the steel itself, not the cargo inside it. You are not, fundamentally, in the shipping business. You are in the asset cycle business, and the cargo is what pays the light bill while you wait for the cycle to turn. This is precisely the model behind the large, publicly listed shipowning groups that dominate headlines in this sector, companies like Frontline and Starbulk Carriers. Built by owners known for timing acquisitions at cycle troughs and disposals at cycle peaks, rather than out-negotiating charterers on day rates. The best-known names in this business spend surprisingly little time thinking about freight. There is also a floor built into this trade that most other asset classes do not have. Even in the worst freight markets, a ship retains its scrap value, the light displacement tonnage that a recycling yard will pay for regardless of what the cargo market is doing. That scrap floor means a well-timed purchase carries downside protection. An office building or a factory never will. Worst case, the hull is still worth its weight in steel. Best case, the same hull rides a multi-year rally into a sale price several times what was paid for it. Few other capital assets let an owner lose that little on the downside while capturing that much on the upside. A mid-size owner running a 10-vessel Cape-size fleet who correctly times even 2 full cycles across a career can generate more wealth from buying and selling steel than from decades of hauling cargo across the Pacific. The freight income pays the crew and the mortgage. The cycle is where the equity gets built. Everything else in this video is overhead sitting on top of that one bet. Every ship built today has an expiration date. And what happens on that date is the part almost no one outside the industry understands. When a vessel reaches roughly 20 to 25 years old, dry docking and compliance costs start to outpace what an aging hull can earn. And the owner sells it not to another operator, but for scrap. Over 80% of the world's end-of-life ship tonnage is disposed of on 3 beaches: Chattogram in Bangladesh, Alang in India, and Gadani in Pakistan, using a method called beaching, in which the vessel is run aground at high tide and cut apart by hand on open sand. The ship that spent 25 years carrying the world's trade ends its life on a beach. Beaching yards pay owners more for a dead ship than compliant facilities do historically, in the range of $400 to $440 per light displacement ton. The weight of the vessel's steel and machinery against roughly $240 per ton at a properly regulated yard in Turkey or the European Union. That gap, multiplied across a 40,000-ton hull, is the single biggest financial reason the dangerous option keeps winning. Since 2009, the NGO Shipbreaking Platform has documented at least 249 worker deaths in Bangladesh's yards alone, from explosions, falls, and being crushed under falling steel. Someone else's life becomes the discount. That liability does not stay on the beach. Under frameworks like the European Union's ship recycling regulation and in a precedent-setting Dutch case, a shipowner was found criminally liable for selling vessels to a yard whose methods, in the court's own finding, endangered the lives and health of its workers. The buyer of the scrap steel is rarely the one who answers for it. The seller, the owner who profited from the ship for 25 years, increasingly is. Now add that liability and the legal and reputational exposure that comes with it to the $64 million paid for the ship at the very beginning of this story. It was never priced into the purchase. There is a second clock running on every ship built today, and it is louder than the freight market. The International Maritime Organization, shipping's global regulator, has committed the industry to cutting the average carbon intensity of every vessel by 40% by 2030, measured against a 2008 baseline, on the way to a target of net zero greenhouse gas emissions from international shipping by around 2050. A ship ordered today with a working life of 25 years will still be trading in the early 2050s. The regulation is going to outlive the ship's original business plan. The industry's own classification societies, including ABS, have published outlooks acknowledging that hitting these targets requires a wholesale shift toward alternative fuels, ammonia, methanol, and green hydrogen derivatives that today's conventional bunker fuel, priced around $650 a metric ton in Singapore as of this month, was never built to deliver. A dual-fuel Newcastle-Max bulk carrier ordered for delivery around 2026, capable of running on ammonia, costs in the region of $125 million, nearly double the price of a conventional equivalent hull. The clean version of the same ship costs almost twice as much. This is not only a problem for future new builds. Existing ships are already scored against two mandatory measures: the Energy Efficiency Existing Ship Index and the Carbon Intensity Indicator, which grade every large vessel's efficiency on a letter scale each year. A ship that scores poorly for 3 consecutive years can be forced into a corrective action plan or barred from certain charters altogether, regardless of how sound the hull otherwise is. An owner who financed a conventional vessel over a 15-year loan is now financing an asset that regulation can partially strand years before the debt is paid off. Shipping's own classification societies are not shy about saying so. The owners who are ahead of this are not waiting for 2050. They're ordering dual-fuel vessels now, capable of running on conventional bunker fuel today and switching to ammonia or methanol as supply infrastructure matures, and locking those higher-cost hulls into long-term charters with cargo owners, mining companies, and commodity traders who face their own emissions reporting obligations and are willing to pay a premium day rate for a vessel that lowers the reported carbon footprint. The premium fuel buys a premium customer. This is also reshaping who gets access to capital in the first place. Banks and leasing houses financing new tonnage are increasingly pricing conventional, fuel-inflexible hulls at a higher risk premium than dual-fuel vessels, on the assumption that a conventional ship built today will need an expensive midlife retrofit to remain compliant, or will simply trade at a discount as charterers steer cargo toward greener tonnage. The cost of capital itself is starting to price in the clock. That premium charter turns an unpredictable spot market asset into something closer to a bond, a fixed income stream, secured against a counterparty with its own reasons to keep paying. The capital cost is real, and it is front-loaded. The economics of the transition, if you get ahead of it, are not necessarily worse than what you are replacing. The capital work is. Return to where this video began. More than 100,000 vessels, moving over 80% of the world's trade, on hulls that cost tens of millions of dollars and can still lose money while sailing full. Those numbers have not changed. What has changed is what they mean. The ship is not really a transportation asset earning a service margin. It is a highly leveraged commodity bet whose real profit sits in the buying and selling of the hull itself across a brutal, repeating cycle, a bet that carries an uninsured liability waiting at the end of its working life on a beach in South Asia, and a regulatory deadline in 2050 that most vessels on the water today were never designed to meet. Owning a ship is either one of the last great asset cycle trades left in a globalized economy, or a 25-year wager against a decarbonization clock that is already running. You decide.